Hey, wealth builders. So imagine this. You're just chilling, sipping kopi at 10 in the morning on a weekday, while everyone else is squeezing onto the MRT or stuck in yet another Zoom call. No more Monday blues, no more toxic bosses, because, well, you've hit financial freedom before 60. Today, I'm going to break down exactly how Singaporeans like you can make this happen by using CPF as your rock-solid safety net and dividend investing as your cash flow machine. Plus, the U.S. Federal Reserve is about to cut interest rates for the first time in 9 months. Yeah, even Trump is calling for a big cut. I'll explain what this means for Singapore dividend investors and how you can position your portfolio to benefit. Make sure you watch till the end, because I'm going to reveal the biggest mistakes most people make that completely derail their FIRE journey. You really don't want to miss this. And hey, like this video so more Singaporeans can learn how to achieve financial freedom, subscribe to Wealth for You, and hit that notification bell so you won't miss my weekly deep dives into CPF, REITs, and dividend investing. Just a quick disclaimer. This video is for education and entertainment only, not financial advice. Always do your own research or speak to a licensed financial advisor before investing. Chapter 1. What does retiring early really mean? Let's get one thing straight. Retiring early doesn't mean you stop working completely and just NUA at home watching Netflix all day. What it really means is reaching that magic point where your passive income covers your living expenses, your food, your housing, your transport, your kopi money, so work becomes optional, not compulsory. This is the point where you can finally say yes to work you love and no to bosses you hate. You can take a 3-month break to travel or go on a staycation every quarter. You get to spend more time with your kids, take care of aging parents, or pick up that hobby you've been putting off for years. Financial freedom is not about doing nothing. It's about having choices and control over your time. And in Singapore, you have 2 powerful tools to help you reach this stage. CPF LIFE payouts, your guaranteed lifelong paycheck from age 65, forming your safety net. And dividend investing, which starts paying you much earlier, even in your 30s or 40s, so you don't have to wait till retirement age to enjoy cash flow. Think of CPF as the foundation that keeps your income steady, and your dividend portfolio as the engine that gets you to early retirement years before the official age. And here's the best part. The earlier you start building these income streams, the sooner you can look your boss in the eye and say, "Thanks, but I'm done." Chapter 2. CPF as your early retirement foundation. Let's start with the cornerstone of your financial plan, your CPF. Know exactly how much you have in your OA, SA, and MA. That's your ordinary account, special account, and MediSave account. These 3 accounts are like your silent workers, compounding quietly in the background while you go about your life. At age 55, your retirement account will be created, and this is where your future CPF LIFE payouts will come from. Your guaranteed, government-backed paycheck for life. Here's a pro tip. If you can top up to the full retirement sum, or even the enhanced retirement sum, this is like building yourself a permanent, inflation-beating income floor. Every dollar you top up is buying you bigger, lifelong payouts later. Peace of mind that your basic living expenses are covered no matter what the market does. Think of CPF as the bond allocation of your retirement portfolio. Ultra-safe, predictable, and growing at 4% in your SA or RA, risk-free. This rock-solid foundation gives you the confidence to invest the rest of your money in higher-yield assets, REITs, dividend stocks, ETFs, without worrying about losing sleep when markets fluctuate. When you have CPF as your base, every other investment you make becomes a bonus, not a necessity. Chapter 3. Building your dividend cash flow machine. Once your CPF foundation is set, it's time to build your own dividend cash flow machine. an engine that pays you every month whether you work or not. Here's a simple rule of thumb I like to use. R is greater than G. Your investment returns should grow faster than your salary growth. That means letting your money work harder than you do. So over time, your investments become your main income stream. Let's put some numbers to this. If you start with $240,000 invested in a portfolio that yields around 5%, you're looking at roughly $1,000 per month in dividends, enough to cover groceries, utilities, or even your JB weekend trips. Then you add to it consistently, say $500 a month, and reinvest all those dividends back into your portfolio. Over the long term, thanks to the power of compounding, that pot could grow to around $1.2 million, paying you about $5,000 per month in dividends. Of course, this isn't guaranteed. It assumes a steady 5% yield, capital growth over time, and your discipline to stay invested and keep contributing even through market ups and downs. But this example shows what's possible when you stay consistent. Think of it as a ladder you're climbing, step by step. $100,000, the hardest milestone, but the point where dividends feel meaningful. $400,000 covers recurring bills like utilities, insurance, and groceries. $800,000, that's lean fire, where you could scale back work or semi-retire because most essentials are paid for. $1 million. A psychological milestone that signals real independence. $1.2 million buffer, covers lifestyle extras and protects against inflation. $1.5 million. That's fat fire, where you're fully living on dividends with a margin for travel and luxury. Every milestone you hit gives you more freedom, confidence, and peace of mind, because you know your money is working for you, not the other way around. Chapter 4. Why the Fed rate cut matters. Here's where today's news gets really interesting. The U.S. Federal Reserve is widely expected to cut interest rates by 25 basis points, the first cut in 9 months, as they try to support a slowing job market while still keeping inflation in check. Even President Trump weighed in, calling it perfect for cutting. But why should Singapore investors care what happens in Washington? Because when the Fed sneezes, the world catches a cold. And this time, the sneeze might actually help us. Here's why. Cheaper borrowing costs. Lower rates mean REITs, business trusts, and dividend-paying companies can refinance their loans at lower interest rates. Less interest expense means more distributable income, which can support or even grow your dividends. Next, capital rotation into yield assets. When U.S. rates fall, safe assets like treasury bonds and savings accounts pay less. Global investors start hunting for yield, and markets like Singapore, with our REITs and high-dividend stocks, suddenly look very attractive. That inflow of capital can lift prices. And then, lower fixed deposit returns. As rates fall, bank FD and savings rates often come down too, making it less attractive to leave cash sitting idle. This money tends to get redeployed into higher yield investments, like REITs or dividend portfolios, giving them another boost. But let's add a little nuance here, because it's not always a straight lineup. Markets often price in rate cuts ahead of time, so part of this good news may already be reflected in current prices. And if the Fed is cutting because the economy is slowing sharply, company earnings and rental growth could be weaker, which may cap the upside. That's why it's crucial to focus on quality names with healthy balance sheets and low gearing. Those are the companies that can refinance cheaply, ride out economic slowdowns, and continue paying reliable dividends, even if things get bumpy. Chapter 5. Singapore Dividend Investing Strategy. Okay. Now let's talk about how to actually build your dividend portfolio engine, the machine that will pay you month after month, even when you're chilling in JB having dim sum. I like to think of my portfolio as having 4 key pillars. First pillar, banks. DBS, OCBC, UOB. These are the heavyweights of the Singapore market. They pay some of the most reliable dividends, and when interest rates are elevated, their net interest margins stay fat, which means more profits and bigger dividends for shareholders. DBS especially has a habit of rewarding shareholders with special dividends when business is booming. Second pillar, REITs. This is where you get consistent quarterly payouts. When interest rates start coming down, which is exactly what the Fed is signaling right now, REITs tend to benefit because their borrowing costs drop, leaving more distributable income for you as an investor. Think Capitaland Integrated Commercial Trust, Ascendas REIT, Mapletree Logistics Trust. These give you exposure to office, retail, industrial, even data centers. Third pillar, business trusts. I like to sprinkle in names like Netlink NBN Trust, which earns steady, regulated cash flow from Singapore's fiber network. These can juice your portfolio yield, but you don't want to go overweight. Keep them as a complement, not the main dish. Fourth pillar, bond funds and global dividend ETFs. Even if you love dividend stocks, you still need stability. Bond funds like the PIMCO Income Fund give you predictable monthly payouts and help smooth volatility. And when interest rates fall, these funds can also see capital gains. For extra diversification, add a global dividend ETF or fund that spreads your risk across different countries and sectors. For example, Lion OCBC APAC Financials Dividend Plus ETF or YLD. These give you exposure to blue-chip companies around the world, but with the convenience of trading in SGD. And here's the secret sauce. Focus on dividend growth stocks within Singapore. Companies like Sheng Siong and ST Engineering that not only pay dividends, but consistently raise them year after year. That means your income grows faster than inflation, and your yield on cost improves the longer you hold. This mix of banks, REITs, business trusts, bond funds, and global dividend ETFs gives you a well-balanced, globally diversified portfolio that can weather interest rate cycles and keep paying you steadily, no matter what the market is doing. Chapter 6. Practical Tactics to Supercharge Your FIRE Journey. Now, let's get tactical, because knowing the strategy is one thing, but actually putting it into action is what gets you to FIRE. First, if you see quality dividend stocks or REITs trading at attractive yields, lock them in now. When interest rates fall, and the Fed is already hinting at cuts, prices may run up, pushing yields lower. Don't wait until everyone is chasing them. Next, be selective. Lower rates might give heavily indebted companies a temporary breather, but if they've got weak cash flow or payout ratios above 100%, that's a red flag. Stick with businesses that can comfortably cover and grow their dividends. Automate your investing with a DCA plan, dollar cost averaging every month. This takes emotions out of the equation so you're not second-guessing whether to buy during market dips or rallies. Track your yield on cost like a proud parent checking a report card. Every dividend reinvested is like adding more fuel to your compounding engine, getting you closer to financial freedom. And finally, control lifestyle creep. You don't need to live like a monk, buy good, reliable stuff that makes life easier, but skip the unnecessary splurges. Spread your spending so you spread your happiness too. Chapter 7. Mistakes to avoid on the road to FIRE. Alright, let's talk about the landmines that can blow up your FIRE plan. Because avoiding mistakes is just as important as picking the right stocks. First, landmine, chasing high yield blindly. That 8% or 10% yield might look tempting, but it could be a trap. Always check payout ratios. You want them comfortably below 70%, and make sure earnings are actually growing. Second, speculating on rate moves. Yes, the Fed is cutting, but don't go all in just because you think the market will shoot up. Build positions gradually and focus on long-term quality. Third, lifestyle creep. That condo upgrade or fancy car might feel like a reward, but it can delay your FIRE target by years. Remember, Every dollar you don't spend today is a soldier that can earn dividends for you tomorrow. And finally, emotional selling. Corrections happen every 6 to 12 months, bear markets every 5 to 10 years. They're not a sign to panic. They're your chance to buy at a discount. As Peter Lynch famously said, the key to making money in stocks is not to get scared out of them. Final thoughts. So here's the big takeaway. Early retirement isn't about being filthy rich. It's about buying back your time. Your CPF is your rock-solid foundation, guaranteeing you lifelong payouts from 65. Your dividend portfolio is your cash flow engine, paying you month after month long before that. And compounding? That's the secret weapon quietly working in the background, turning small monthly contributions into a life-changing portfolio over time. And right now, with interest rates coming down, this could be the perfect window to start or accelerate your dividend journey. Lower borrowing costs help REITs and businesses, bond funds get a boost, and yields today might look very attractive compared to where they'll be a year from now. Put all of this together, and you have a clear, actionable path to retire before 60, without guessing, without gambling, and without sacrificing the life you want to live. If this video gave you clarity or motivation, smash that like button so more Singaporeans can see this and start building their own FIRE plan. Drop me a comment below. What's your early retirement number? $800,000? 1.2 million? Maybe even more? I want to hear from you. And of course, subscribe to Wealth for You and hit the bell so you never miss my weekly deep dives on CPF, dividend investing, and passive income strategies. Together, let's build cash flow, retire early, and live free. See you in the next video.